Hello everyone. I have a new history talk for you tonight, one about the history of money. I will tell you about its forms, how it worked from prehistory to our days, and its definition. Or maybe its definitions in the plural, because money is one of these terms that we all immediately understand. We get what it's about every time we hear the word in a given context. But depending on this context, the meaning is different. Sometimes we refer to money as a mean of payment, an amount that changes hands between a buyer and a seller, either physically, in cash, or electronically. But it can also be a unit of account that helps us compare the value of things on a scale, an unified scale, that connects little things like a cup of coffee to big things like houses. Something is worth X dollars, euros, pounds, crowns, pesos, yens. In that sense, we could think of money as a kind of language, the language of economic value. Thanks to it, a buyer and a seller, who never met before but use the same currency, can communicate and decide whether they want to make a transaction. Yet another meaning is when we use money as a synonym for wealth. When we talk about how much money someone has, this is not literal. We are not talking about the coins in their pocket or the balance on their bank account. We are talking about what they possess, the value of their assets expressed in a unit we understand. So here we tend to conflate material wealth with the unit in which it is expressed. We'll see that this distinction matters. And on top of that, because money is so used and important in our lives, it is loaded with subjective and emotional layers. It comes to represent intangible concepts like freedom, autonomy, security, power, status. So there's a lot to discuss here that is not purely historical, but we'll get to it as we travel along the centuries. All you have to do for now is make yourself comfortable, focus for a second on your breathing, and just close your eyes if you wish to. You can follow this journey just by listening, and you can always come back later if you fall asleep. And now, let's get started. I mentioned these different definitions of what money is right from the start, because without definitions, we cannot talk about a history of money. Our first reaction when thinking about when money started to exist, historically, may be to think about the first coins, if we think of money as a mean of payment. But there were transactions, economic transactions between people, long before the first currencies were invented. Transactions made through barter, for example. Prehistoric barter could involve items directly useful in themselves, like livestock, salt, grain, or, at least archaeology suggests, they also served things that were visually appealing and relatively rare, like certain shells, beads, or ornaments that were desirable enough to be accepted as a counterpart for more useful commodities. So these items used for barter, be they useful or not, became means of payment in transactions. Does it make them money? No. Because money is a system separate from the goods and services that are traded. A system invented to express their value, to keep accounts, and do transactions physically. Now, a risk of misrepresentation exists if we imagine prehistoric societies practicing barter very intensively, as if they had a developed market where people would regularly trade goods. Barter existed, yes, but market exchange was very little developed for most of humanity's history. And it is logical. When people live a nomadic life in small groups that were generally extended families, and people rarely ever met other groups, because human density was low, the conditions for an active market to exist were not met. Anthropologists describe these non-monetary societies more like gift and debt economies. Things like food or objects were just given to members of the group by those who procured them. They would be repaid later by other gifts or repaid in intangible ways: admiration, power, respect, status. So in everyday life, there was not really a market. Within a small group of a few dozen people at most, with not much to trade, the concept of a market doesn't really make sense. The point is that during most of prehistory, even though it happened, barter probably was never the main mean of exchange. Instead, transactions combined economic elements with social elements. People gave away and received things out of a social obligation, as a way to survive, or out of affection, or to endorse a role as a caretaker. And these are ways of exchange that still exist today, obviously. When we help out a friend or a family member, when we educate kids, or take care of elderly parents, we may or may not expect reciprocity in the future, but we are not supposed to send an invoice. It is an economic activity in the sense that work is performed, time is allocated, but it is not a market transaction with a price tag. The market has certainly entered many more aspects of our lives in the past few centuries, but a lot of work and exchange continues to happen out of it. From domestic work to gifts of all sorts, in time or material things, to education. So internal barter in prehistoric groups was probably very limited, but it may have been more developed between prehistoric groups when they met. But the way it worked left no trace, and we can only deduce it happened because resources were found very far from their place of origin. So we know a form of trade took place. But we cannot measure the phenomenon or know precisely how it was done. Historically, classical economists since Adam Smith have supposed that money emerged from barter, because barter has big limitations. You need to find someone, a trading partner, who wants something you have and has what you want. It is complicated and much more efficient to introduce something, an unit, that is going to be recognized by all trading partners. This makes sense intellectually, and it is reasonable to assume that money was invented as a way to facilitate exchanges. and allow their volume to increase. But maybe not as Adam Smith imagined, from a realization that barter was impractical. First, because as I said, barter was probably never that common, at least not common enough to say that it created a real market. And second, because based on archaeology, coins or any types of tokens used as exchange money appeared long after accounting money. What does it mean? Thousands of years before the first coins appeared, as far as we know, the first accounting records were created. The oldest known ones were found in Mesopotamia, and they date back to 5000 BC, 7,000 years ago. These records consist in lists of expenditures and goods received or traded away. And interestingly, these items, spendings, revenues, the value of goods, all of these were expressed in an unit, and that unit that allows for the quantification and the comparison of prices, values of different things, this is money, money of account. Which means this unit would have existed long before it became physical coins or other representations of money used in transactions. In that sense, money is one of the many expressions of humanity's ability to think symbolically, to create symbols that serve as tools to think, interpret, navigate the world. And only later came a form of money of exchange, but not as coins yet. Here again, archaeology tells us that before coinage, several ancient civilizations invented representative money. That is to say, there were official institutions. This was observed not only in Mesopotamia, in China, India, or Egypt too. So institutions like palaces, temples, state treasuries that stored commodities in their warehouses, and they would issue tokens that could be made of clay or other materials that these institutions recognized as theirs, as official, and that served as evidence of a claim upon a certain quantity of the goods stored in their warehouses. So a kind of ancient receipt. The receipts, the tokens, had no intrinsic value by themselves, but their carriers could obtain a given quantity of these stored commodities against them. So this is money, representative money, a type of monetary system we will encounter again later, when central banks or other institutions issued banknotes guaranteed by their stock of gold or silver. These banknotes would be convertible in gold at any time, guaranteeing public trust in their value. But long before that, in the case of these first occurrences of representative money, thousands of years ago, it doesn't seem the tokens issued served also as a mean of payment on a market. They remained used only for administration and accounting. But still, they were a form of money. And still before the first coins were ever minted, other objects around the world became early forms of exchange money. That is to say, a particular object or a quantity of something that serves to price and exchange other things. For example, in ancient Mesopotamia, bars of metal played this role before there were coins. But many different objects have been turned into monetary tokens, not necessarily very precious objects. Like salt, for example. At different periods, it was accepted as a mean of payment in ancient China and around the Mediterranean. or cattle in ancient India and Africa. In ancient Mexico, cacao beans also became money, or in different regions of Africa, there were iron rings and bracelets, or metallic rods like rods of brass. In islands around the Pacific, people adopted a lot of different items as money of exchange. They were creative. In Fiji, whale teeth. In the Solomon Islands, feathers. Or in the Yap Islands, stone discs. Even though these early forms of money have been mostly replaced with fiat currencies nowadays, we'll talk about them later, the practice of turning tokens into a mean of payment on a smaller scale, not an entire economy, but rather an establishment or an ecosystem, this has not disappeared. For example, chips in casinos. Their intrinsic value is almost zero. They are bits of plastic. But they have value because they are recognized and guaranteed as a form of money within the limits of a casino. The casino guarantees their convertibility. Or there are virtual currencies that can be used to buy virtual equipment in some video games. This too is a form of localized money of exchange. But the very first coins, as far as we know, appeared in the 7th century BC, about at the same time in China and in Anatolia. In China, a coin factory was discovered by archaeologists in the city of Guangzhou in the province of Henan in central China. It minted bronze coins for apparently about a century. And about at the same time, the first coins were produced in Anatolia, modern Turkey, in the kingdom of Lydia. I told you about Lydia in past episodes. It was a kingdom in the west of Anatolia, and it ended up covering about half of it. Lydia was rather influenced by Greek culture. It was contemporary to the archaic period in Greece. It peaked by the middle of the 6th century BC, under a king called Croesus, famous for the immense wealth of his kingdom, which may have been a bit legendary, the wealth, not the king. But it is true that Lydia had access to big deposits of gold and silver, often coming together naturally, a natural alloy called electrum. Lydia disappeared despite its prosperity, because it fell to the much more powerful Achaemenid Empire, the Persian Empire, in the 6th century, and it became one of its provinces until the Greek conquest led by Alexander the Great expelled the Persians and took it. It seems the very first coins produced in Lydia were made of electrum, and initially they were more badges or medals issued by priests, made of this natural electrum. In the first decades they were not really used as money. A problem they had was that natural electrum may contain a very different percentage of gold. It can be about half the weight, but sometimes much less or much more. So the value of these first coins was unpredictable, and it probably slowed down their development as a form of money, until the proportions of each metal in the alloy were standardized. Coins made of precious metal have a big advantage on other forms of exchange money. They inspire trust because the value of a coin is backed by what it is made of. It is way easier to trust them than a token that can be harvested in nature, like a shell or a feather, or manufactured, mass-produced, like a stone disc. And because they are made of precious metal, they can also serve for international trade. These Lydian electrum coins were used mostly for relatively big transactions. They were not convenient for small purchases, because according to historians, the smallest denomination coin would have represented about 1 day of work of a regular worker. So impossible to use it to buy different food items. It was too valuable, and there were no smaller coins to give change back. This apparently changed as the Greeks replicated the Lydian idea. And in the 6th century BC, they started to produce coins with smaller denominations, small silver coins that could be used for retailing. So the very beginning of coins for small purchases, what we tend to think they are made for, is not something that ancient. It started about 2500 years ago. For small purchases, these Greek coins began to spread, but only slowly, and in limited regions of the world. And for larger purchases, transactions made by merchants, the coins coexisted with larger bars or ingots of precious metals, especially silver, or even more common metals like copper and bronze. We have examples of this in the Iron Age in different places. In China, around 2500 years ago, various governments, various kingdoms, produced something called knife money. Knife because these were large bronze bars shaped as knives. They were standardized in weight and shape, and they were used to transfer value or store it. The Persians used silver bars for trade, alongside barter, a practice that was also present in Central Asia. The Phoenicians, who were a very dynamic people in that period, they competed with the Greeks to found colonies and develop trade networks around the Mediterranean. So the Phoenicians had standardized metal ingots, and they started to stamp them with the name of their rulers in order to guarantee their value. It could have been a way of promoting the use of this form of money, and it could also have been for political propaganda, probably both. But this reflects the growing practice that appeared at the time to mark physical money, to stamp it with symbols, names, portraits, in order to show they were official. The power to issue coins or other means of payment, as soon as their use spread, this is something strategic. It gives to kings and governments a degree of control on transactions. It's a very good support for propaganda, one of the first ways for rulers to reach the everyday man, at a time when there were obviously no news outlets, nor much circulation of writings. I told you the Lydians had been precursors in the Mediterranean in introducing electrum coins under King Croesus. On top of that, they also started the first standardized gold coins that would circulate at the same time as electrum and silver coins, with a fixed parity between them. This is what is called a bimetallic monetary system, based on more than one precious metal. I told you the Greeks adopted coins after the Lydian example, and so did the Persians, which was way more impactful because this empire was by far the largest in the world in the 6th and 5th centuries BC. It covered almost all of the Middle East, all the way to the doors of India and Central Asia. So this spread the idea of gold and silver coinage very far from its cradle. And an illustration of that is the discovery of a treasure near Kabul in Afghanistan in 1933. The Kabul hoard. It consisted of approximately 1,000 coins, a collection dated to the early 4th century BC, with Persian, Achaemenid, and Greek coins. All of them made with punch-marked techniques. They had faces, symbols, writings. It revealed a wealth of information and confirmed that coins circulated quite far from their place of origin at the time. They served as means of payment, but also as stores of value. That's what a coin hoard is for. And it also tells us that coins were beginning to be a support for art. There was obviously an aesthetic intention in the way they were designed. They're made to look good. And that's probably revealing of the status that these coins, the material, physical manifestation of money, were taking in antiquity. They had become worthy of fine craft, fine art. Part of it is probably because they were political marketing or propaganda supports, but there is certainly more to it. Money had become meaningful, desirable for itself. Money, not just wealth. Because again, money is not wealth, it is not comfort, it is not power. It is an unit that quantifies and facilitates exchanges. You cannot eat it or live in it. It will become tangible wealth or comfort only when it is spent. But as a metaphor, a potential, it is highly desirable. On top of being a unit of account and a tool for exchanges, it becomes its own entity. An entity so evocative that we confuse it with wealth. It certainly didn't create the appetite for wealth or greed. There are many examples, descriptions of individuals, institutions, or kingdoms that were very wealthy and were admired for it, or criticized for it in the centuries before exchange money spread. So wealth caught people's attention long before money of exchange was even introduced. This is not the invention of greed, it is the installation of a symbol that is perfect to quantify wealth, transport it, and transform it into other assets, goods or services. And because we use money daily, even dematerialized money for the most part nowadays, the illusion or the confusion with wealth is constantly reinforced. And by the way, this is not the only representation that we confuse with the real thing. It could be argued that we also do it a lot with words and images. Images are just representations of something. They evoke the thing without being it. For example, when shown a drawing of a table, we are going to say it's a table, even though this is obviously not a table. It is literally a sheet of paper with some lines on it. We say that because the drawing evokes a table, a recognizable form. It is a symbol of a table that was created without the intervention of any real existing table. But we don't think like this, and distinguishing the image from the real thing even sounds a bit stupid or pedantic. The way our minds work is by mixing perceptions of the physical reality with symbols we've learned to recognize, and even metaphors. When we use in sentences words like the table of negotiations or having a seat at the table, clearly there is no table involved, real or in representation. We reuse the concept of a table to create a metaphor that expresses something that no longer has anything to do with the real physical thing, nor even its representation. That's for images, but actually it's not just pictures. The names we give to things are also symbols. They are sounds or written words that evoke what they name. And to understand how the human mind works, it is good to bear in mind this constant circulation between different levels of perception, of symbols, of metaphors, that helps us think and communicate. This gives us a great power of conceptualization, of creative thought, but it may also hide us the true nature, the essence of reality. Maybe we got lost sometimes in the various layers of our perception and thought process. I am telling you this because maybe something similar happens with money. It is a symbol entirely created by humans, a representative unit. We use it as a language to express the value of things, and it also quickly became a metaphor for everything we can project onto it. The desire for security, comfort, status, power, peace of mind. This is what makes it complicated to give a short, simple definition of what money is. It is many things at the same time, depending on the angle: economic, anthropologic, psychological, emotional. But returning to antique coins, my point was that for these reasons they could not have been, simply a neutral instrument. They were loaded with political significance and a complex collective imaginary, which also makes them very evocative of past cultures. On top of their diversity, their craftsmanship, their beauty, or their rarity, they are appealing to collectors because they are also vivid reminders of real human life of past eras. The period of generalization of coins in urban civilizations of the Old World is the 5th to the 3rd or 2nd centuries BC. About at the same time, coinage became widespread in China, in India, and around the Mediterranean, and not just anymore with gold and silver. For coins of smaller denominations, the growing acceptance of coins and the fact that their issuance was strictly prohibited to anyone but the authorities, this allowed for the appearance of coins made of less valuable metals, like bronze and brass. The constituents of these alloys, copper, zinc, or tin, were not very precious. They were more costly than today, because the quantity in circulation was limited, but they never reached high prices. And the value of these small coins, useful to the average person to receive their salary and make small purchases, their value as coins was often superior to the value of the metal they were made of. This is a sign of trust in the control of authorities over the economy, at least minting, and of trust in their future, their perpetuation in power. A big contributor to the generalization of coins would be the Roman Empire, obviously. But not early. The Roman Republic was late in adopting coinage. It started near the beginning of the 3rd century BC. This is late because at the time, coins were already circulating around the Mediterranean and the Middle East. In the Hellenistic world, we are now past the conquests of Alexander the Great and the diffusion of Greek culture and practices to large parts of the Middle East and beyond. The Romans started coinage later than others, mostly because Italy lacked precious metals. Some of the first Roman coins were made of bronze. But as the Republic expanded and turned into an empire, which ended up controlling the entire Mediterranean Sea, internal trade grew considerably. Rome became the largest issuer of coins to date, with different coins of gold, silver, copper, and bronze in particular. Actually, the word money comes from moneta. Moneta was an epithet of goddess Juno, the Roman equivalent to the Greek Hera, Juno Moneta. And for several centuries the temple of Juno Moneta in Rome contained the Republic's mint. The word mint also comes from moneta. This aspect of goddess Juno became by association a personification of money. As Rome expanded, other mints were opened around the empire, and they constantly minted coins, especially when a new emperor started his reign. The coins would be updated with the portrait of the new emperor. Roman currency had several different names depending on the types of coins, what they were made of, and the periods. There was the denarius, the standard silver coin, the aureus, the gold coin, the sestertius, a small silver coin under the Republic, but still relatively rare at the beginning. Later it became the name of a brass coin. What Roman currency is also famous for, especially as time passed, is its regular debasement. What does it mean? When you are a government with a legal monopoly on the issuance of coins, and you need more money, which is the fate of many governments, debasing the currency is an idea that sounds very attractive, at least short term. So what is it? When the first coins were issued in Lydia, their value was that of their content in precious metal. And this gives a lot of trust in the value of the coins, obviously. If you had Lydian coins, even assuming the kingdom of Lydia would disappear, you could still smelt them and keep their value. But in the Roman Empire, and this went on after the fall of the Western Roman Empire, coins had become more widespread and used, and there were coins of different types and value already in circulation. At the time of minting new ones, the temptation to produce them with less precious metals content was strong. Instead of gold coins that are close to 99% gold, let's make them 90% or 80% or less. This is a way of creating wealth for the issuer of the coin. Just by minting a stock of gold or silver, its monetary value increases. The coins are valued at more than their precious metal content. Of course, it doesn't create real wealth. It is just a trick, a form of invisible tax on people who will receive this money as payment. People were aware of this debasement, and if you know that the coins contain less precious metal, as a seller you're going to ask for more of them. In other terms, prices expressed in the currency rise. There's inflation. This inflationary debasement of the currency was a constant during the last centuries of Roman history. Prices rose regularly, and people still accepted the currency, but its value was seen as declining. There is a similar phenomenon even with dematerialized money. For example, from time to time, you hear people saying things like the central bank can create money out of nothing. So why not give some to everyone and solve poverty this way? Why not give $1 million of new money to everyone? obviously because money is not wealth, it's an unit. Putting more of it in circulation is not going to multiply houses, businesses, food, the quantity of goods, or of work hours available. All of these will stay the same. There is no wealth creation here, just a trick. As a result, if this was done, either the new money would not be spent and nothing would happen, or it would be spent and the consequence would be an increase in prices, inflation, while the overall level of wealth would remain the same. Now, monetary creation has its merits in economic policy. It may help absorb shocks, and long-term, a moderate but positive inflation rate is rather beneficial to the economy for other reasons that have to do with the projections that economic agents make. Apart from that, it is also necessary to increase the quantity of money in circulation as an economy grows. But printing money is an illusion, economically speaking. When a government does it, it is a form of invisible and painless tax on the population. It gives the government resources to spend, and people will pay the tax every time they buy groceries, cars or houses at inflated prices, because there is now more money circulating. There is no escape to the fact that if we want more general wealth, or reduced poverty rates, it can only be achieved by either producing more or redistributing more, or both. But there is no magic money trick that will achieve that without efforts or policies. Returning to late antiquity, after the fall of the Western Roman Empire, Roman coins continued to circulate. For example, in Frankish kingdoms of Europe, the common money of account and exchange was the solidus, another Roman coin from the late empire. The economic importance of the Roman Empire had been such that the names of various currencies still bear that heritage. Solidus became sol, and then sou in French. The Arabic dinar comes from the denarius. If you ever wondered where the name dollar came from, this word actually traveled a lot. It started with a town in the kingdom of Bohemia, Joachimsthal, which had a silver mine nearby, and where silver coins were made in the 16th century for the kings of Bohemia. Nowadays this town is in the Czech Republic. So, as they came from Joachimsthal, a German name that translates to the Valley of Joachim, the coins were called Joachimsthaler. In common language around the Holy Roman Empire, of which the Kingdom of Bohemia was a part in the 16th century, this was reduced to thaler. Thaler became a more generic name for currencies, including in the Netherlands, which introduced their own thaler in the 16th century, a currency that was used later for Dutch trade internationally, including in the Caribbean and the 13 colonies of North America as they were forming. When came the American Revolution, Britain withheld all supply of currency to the 13 colonies, obviously, and for years the bulk of coins in circulation were foreign coins, primarily the Spanish peso, and to a lesser extent Dutch and French coins. The term dollar was well installed at this point, and after independence, logically the young republic adopted its own currency, keeping the name dollar and initially defining the dollar as a unit of pure silver weighing around 24 grams in 1792. This definition changed several times, and in the 20th century, the US and most countries around the world moved to what is called fiat money, fiat currency. Currencies that are issued and recognized by governments, they are the official currency of a country, but they are not backed anymore by precious metal or something else that you can obtain at the central bank against your coins, your banknotes, or dematerialized money. That's a leap in the way money works compared with previous periods. Fiat money became a norm internationally in the 20th century. And as this type of currency has no intrinsic value, it is not precious metal, and it is not representative of anything you can change it against. Its value is based entirely on trust. Trust that it will be accepted by everyone you exchange with, by a government sitting on an economy stable and resilient enough to guarantee its future value. And also trust in the possibility to exchange your fiat currency for another one, its convertibility. So what these currencies need to exist and retain their appeal is a functioning economy, at the scale of which they are the legal currency, and they need acceptance from economic agents who use them. It is no big concern if you live in a big enough economy with solid institutions. No one is really preoccupied that tomorrow their US dollars or euros or pounds will cease to be accepted. But in less solid economies, that can be a concern. Generally, when there are episodes of hyperinflation, with prices rising every day, what it means is that trust in the currency is evaporating. No one wants it anymore. So the prices of everything, expressed in this currency, skyrocket. Now I told you that fiat currencies became a norm in the 20th century. But their history began earlier, in China, in the 13th century. And to understand what happened, we need to go back a little, go back in time. China was the first country to introduce banknotes, paper money. Starting in the 7th century AD, Chinese merchants who made large transactions had imagined a system of receipts of deposit. Instead of transporting large quantities of coins, which would have been unpractical and risky, they issued a receipt that its carrier could use to redeem the coins where they were kept. This type of receipts circulated for several centuries, they were well accepted, and so they became a type of money, representative money, that could be changed at any time against a given quantity of coins, but that could be also used to pay something else without withdrawing the coins. In the 11th century, the government of the Song dynasty saw the advantages of that system and started printing paper money, a receipt backed by a deposit of something valuable. And in 13th century China, a form of fiat money even appeared, banknotes that had no longer a backing. That was under the Mongol dynasty, the Yuan, and initially their banknotes were backed by stocks of silver. But as the dynasty faced fiscal challenges, an economic crisis and conflicts, it decided to keep printing while eliminating the convertibility into precious metal. Money would now have value by decree of the emperor, and non-compliance, the rejection of paper money, would even be punished. For some time, the large-scale circulation of banknotes worked, and news of this experience reached Europe via travelers like Marco Polo. But it didn't end well. After the convertibility was eliminated, So Chinese money was now fiat money. The printing press produced a large amount of new paper notes without any real wealth to support them. So trust in this currency ended up disappearing. Despite legal threats, the public and merchants rejected official banknotes, and it ended up in hyperinflation and ruin. The Yuan dynasty fell in 1368. Not only for that reason, but the general economic crisis was one of the main reasons for their downfall. And this left traces in China. Banknotes ended up being entirely eliminated, banned, and under the Ming dynasty, China retreated to a hard money system, one based on silver and copper coins for several centuries. While China was conducting these experiences, another part of the world where a monetary economy developed was the Islamic world. Especially in this part of the world, the use of money soared between the 7th and 12th centuries. I told you earlier about the Arabic dinar, which was a currency whose name comes from denarius, the Roman currency. It is famous because for several centuries it served as the currency of trade within the Islamic world, and because trade soared in a space that went from North Africa to the doors of India. A class of traders and merchants doing long-distance trade expanded across Muslim regions. With this, an economic thought developed, and a lot of innovations, or the premises of what would generalize in modern times, were born there. Things like checks to pay and accounts kept by institutions, exchange rates between currencies, the practice of loans, of credit. Lending money was older than that. It probably appeared as soon as money became a thing. But these practices became more common to fund the economy itself, commerce, rather than being limited to loans between individuals or kings and governments borrowing money. You know that Islamic law, the Sharia, and also at the same period the Christian tradition in Christendom, prohibited loans with interest rates. Why is that? Here again we return to the various definitions of money. These religious bans are based on the vision of money as only an account unit, a measure of value, and as a mean of exchange. What they reject is money becoming a product that can be rented out for profit. Because this is what a loan with interest is. The interest rate is the cost of renting money, but you pay this cost in more money. This religious prohibition of loans with interest, that is to say one of the core activities of modern banking, this stayed in place along the Middle Ages in most of Europe. At least it was prohibited to Christians, leaving only non-Christian minorities allowed to work in the money trade, especially the Jews. Historians agree that a lot of old prejudice about the Jews and money took shape in this period, and their persecution at various periods also had to do with debtors, including monarchs, not willing to ever repay what they had borrowed. Examples include King Edward I of England at the end of the 13th century, or Philip II of France in the 12th century. So in Islam, as well as in medieval Christendom, loans with interests were seen as unethical and sinful, on the grounds that money should not be seen as a commodity that can be rented out for profit, because this creates an increase in capital for the lender without any corresponding effort or risk. loans without interest rate were still allowed, but still, despite religious prohibitions, money served as a commodity. There were, and there still are, ways of circumventing the ban. For example, instead of lending money for a house or a car with interest, the bank buys the asset directly and resells it immediately at a higher price to the seller, a price that will be paid in installments. Or the bank buys an asset and leases it to the client, and after a given term transfers ownership to him. These techniques avoid a loan with interest, so technically they respect the letter of the religious law. When it comes to its spirit, it may be more debatable, because clearly in the process money serves as a commodity and generates a profit. But these techniques are widely tolerated across countries that apply some or all aspects of the Sharia. And this is how they have modern banking systems. Speaking of modern banking, its appearance could be traced to the late Middle Ages, especially in northern and central Italy, a region of the world which at the time was relatively prosperous and well inserted into international trade. That's the golden age of merchant republics like Venice and Genoa, or especially from the 15th century and the Renaissance, the rise of city-states like Florence. This mix of economic openness, accumulated capital, knowledge of trade, is the medium where pre-modern banks would appear, with various innovations. Families of bankers, like the Medici in Florence, offered financial services like international bills of exchange. That is to say, they created a network of establishments, opening them directly or via partnerships, and merchants could deposit money somewhere in the network, get a bill of exchange, and withdraw the capital somewhere else. Very convenient for international trade. This is also the time and place where modern bookkeeping was developed. From Renaissance Italy started a movement of innovation and growing sophistication in the business of money that only accelerated in the following centuries. There would be much to say about this, so we will probably return to the topic another time. But just to name a few, in the 17th century, paper money appears in Europe, starting in particular in England. London goldsmiths start to offer a new service to clients. They store their gold and issue paper receipts, notes, that people can trade directly, with the guarantee that at any time the carrier of the receipt can go to the goldsmith and change it into gold. Central banks that basically take on this service and the responsibility for managing money supply with a monopoly also start to appear. The first enduring central bank to appear is the Bank of England in 1694. The Bank of France is created in 1800, and the first US central bank is created in 1791 to manage money supply and regulate credit. It gets discredited by a high inflation after the War of 1812, so it is replaced in 1816 by a second central bank. This one doesn't last. In 1830, it is dissolved by President Andrew Jackson, famously hostile to bankers, on the grounds that a central bank was not accountable to the people. And for close to a century, the US had no central institution responsible for regulating commercial banks, which devolved into a very complex monetary system, one that did not prove very good at ensuring financial stability. There were recurring stock market crashes and bank runs, especially a large one in 1907. This is what led to a large monetary reform and the creation of the Federal Reserve in 1913. There is much more to say about money since the 19th century. Financial markets, how money impacts the economy and our lives. So maybe we will come back to this in a future episode, in which I will detail these aspects, or talk about things like cryptocurrencies, and why, in my opinion, they will probably end up being valued close to nothing. But for now, it is the end of our episode for tonight. I will be back soon, and if you are not sleepy yet, you may pick another story in my library and embark on another adventure. Or you may keep your eyes shut, let yourself go, and fall asleep. Sleep well. Sweet dreams. Au revoir.